Morning.
So we're going to do this a little conversationally, and we're lawyers, so we apologize in advance for any awkwardness along the way here.
There will be some.
There will be some, I guarantee you. Luke, if you're an angel investor and you're looking at a potential investment, tell us a little bit about the instruments that you might encounter. What type of investment specifically would you be looking at?
Yeah, deals can be structured in many ways. There's quite a few investment instruments out there, but I think what we typically see in an angel context is two main instruments: safes, simple agreement for future equity, or convertible note.
Yep. And a little bit of history. So safes are a fairly new construct, call it about the last 10 years. They came out of Y Combinator in California. And notes effectively are debt on the balance sheet, and that has some accounting impacts to the business that a lot of folks were trying to get out of. And so initially, the SAFE concept was designed and developed so that you get out of that, right? It's a contract. It's not gonna be a debt instrument, and you're gonna be able to get rid of that concept.
From when you're taking a look at something, Chris, and you're presented with convertible note versus a safe, I mean, what are your kind of high-level thoughts? Are they essentially the same thing? Are they, super different?
Yeah.
How do you think about that?
I think of them as the same. They're equity at the end of the day. I have a lot of angel investors that come to us, and they think of convertible notes sometimes as better because they have a maturity date, and if they don't get paid back, or their equity doesn't convert into equity, that they have this, they're on top, quote unquote, and they're able to somehow benefit from that, or they can foreclose on the company, or whatever the case may be. That is the wrong way to think about it, right? You're not going to do that. I mean, whatever your check size is, even if it's on the larger size for an angel, if you came to me and told me like, oh, I want to foreclose on this company because I got a note and it's past due, and they haven't called me, and I would tell you to forget about it, right? It's equity, and it's presumably equity that's going down in value. So that was the initial. That's the initial sort of difference. But to me, there's really not a lot of difference. Convertible notes are more complicated. There's an interest component there that converts into equity when the conversion happens. But it's just another moving part that the company needs to deal with. There's some tax consequences to that. There's some tax consequences to the investor on that, especially when you're not actually getting the interest paid to you like a regular note. So as a general principle, I tend to think of a safe as a little bit easier, a little bit more straightforward than the notes. I guess one final comment on that. Safes are a very, very standardized document. One thing in angel investing and sort of venture generally is, which I love, is that there's been this move over the last 20 years to standardize everything. I would say notes, honestly, are still one of those areas that are not standardized, right? You see sort of different variations, different law firms and different investors have different structures, and there's a little bit more complexity there that you need to sort of navigate. Whereas, Y Combinator puts these safe instruments on their website. Everybody basically uses the same thing. It's a very, very easy document to review. It's about 4 pages long, and really is the way to go, in my opinion.
Yeah, I think because of that standardization, you know what you're getting when you're presented a safe, right? A convertible note, if you're not a part of that kind of negotiation, to Chris's point, it could have, it's not standardized, right? There's tons of individual, tweaks that that the company or the lead investor might make. So safes are pretty simple.
Yeah. Luke, tell us a little bit about the economic terms that an angel investor should be thinking about when they're looking at a safe or a note.
Yeah, I think in both scenarios, right, there's two terms that come up from an economic standpoint in nearly every safe or convertible note, and that's a valuation cap and a discount. And I kind of taking a step back there, the safe and the convertible note are both convertible securities, meaning that they aren't equity until they convert. They convert at some trigger, typically an equity financing, the next round, right? And how or what the investment, right, the purchase amount of the safe or the purchase amount of the convertible note converts into is based on the valuation cap and the discount. The discount is straightforward, right? Let's say you put $10 into something at a 20% discount, right? You're gonna get 120, or $12, right? You'll get that benefit. The valuation cap's a little bit trickier, right? I don't want to say that it kind of ties to the value of the company, right? But it's essentially a peg, a monetary peg that we use to derive the per share purchase price that the convertible note or the safe uses to convert, right? Is there anything else that you're thinking about there?
A very simple example. If you have a $5 million cap and the next financing, and we'll talk in a little bit about kind of what does that mean, a next financing. And the next financing happens at a $10 million valuation. Essentially, you're getting a 50% discount to that value, right? So if those shares, when that next round happens, are being issued at $1, your safe or your note is going to convert at 50 cents. So you're piggybacking on that value, and you're getting a discount to that value. Part of the nature of safes and convertible notes is, at least to some degree, you're kicking the can down the road on what the company's valued, right? Angels invest early. It's really hard for both the founders and the investors to put a line in the sand and say, under conventional finance terms, some multiple of revenue, some multiple of earnings, whatever the case may be. It's very difficult to sort of create sort of a numbers value for the business. And so these notes and these safes sort of use a baseline and piggyback on the value that's ultimately going to be coming in the first priced round.
Yeah, I think the core concept there is valuation is specifically at an early stage, definitely more an art than a science, right? There's typically not metrics to peg that valuation, and so the valuation cap kind of speaks towards a bridge, right? As Chris said, kick it down the road a little bit.
Tell us a little bit about, Luke, what angel investors should be thinking about in terms of the cap. What's a good deal? What's a bad deal in today's market, or as a general principle?
Yeah, we get that question a lot, right? I think if you're out there listening about the valuation cap, well, let me get this valuation cap as low as possible. That means I'm getting a good deal, right? And I don't necessarily think that that's maybe the correct way to think about it, right? So if you take a step back, again, these are convertible securities. They're gonna convert on the next equity financing, meaning the company's selling a portion of the equity. You're gonna convert. You're gonna take another portion of that equity, right? And the dilution happens to the founders, right? The current stockholders. And I think what we typically see, right? I mean, and Chris, chime in here. I think, between 3 and 6 million on a cap, right, for kind of early stage. That stretches kind of, as companies mature or kind of, I guess have a more dynamic founder or a more dynamic product, right? That can stretch quite a bit, actually. But I think the purpose of the cap is, one, to kick the can down the road. Kick the can down the road so that the founder maintains a reasonable amount of the company to stay invested, to stay involved, to stay motivated, right? And the angel gets a good deal, right? They get rewarded for putting their money in early, right? And that's kind of the core concept of the convertible securities, right? Is we're putting this in early. We don't necessarily know what the company is valued at, but because of that, we're going to get some sort of discount, right?
Yeah. I think of startups as, delicate plants. And if you overwater them, they just get demolished, right? As Luke kind of alluded to, I think sometimes investors will come to us and say, like, well, we want to push this cap down as low as we possibly can. There's a lot to think about on that front, right? I mean, getting the most of the company isn't always the right answer for the investor. If you get the most of something that's worth nothing, you haven't really succeeded, right? And one of the key tenets, and I'm a little biased, I tend to represent founders, but one of the key tenets is making sure that the founders have enough skin in the game, they have enough equity over the life cycle, the finance life cycle of the entire company, in order to get you where you need to go and to get your return on capital. So, for example, one of the things I always tell angels to talk to the founders about is, what's the finance roadmap of this business? So, we're first of all, we're raising a convertible round, and when we're raising a convertible round, you're going to do another raise, right? You're going to have what we call a price round. You're going to sell securities, and we're going to convert into that round. That's the basic principle of the business. So if a founder tells you, "Well, this is our final round," that's a little bit of a red flag, because you're getting a convertible instrument. What are we converting into? Are we building a bridge, or are we building a pier, right? And if that's the answer, that might actually be the right answer for the finance case for the business. But if it is, then you need to have an understanding of, okay, what's the game plan for converting me? What am I really going to get here? How is it going to work? There probably needs to be an automatic conversion feature, which is a very different, it's not market, and so on. The other extreme would be a very capital-intensive business that is very high growth, where the founders give you a vision that, we're going to be raising a seed round, and then we're going to be raising a Series A round, and then we're going to go deep into the alphabet. And the game plan is to move as fast and furious as we can. We're going to raise a lot of capital along the way. We're going to build the product and the team in an aggressive fashion. And what does that all mean as an angel investor? I think when you're thinking about the cap, what it means is you need to be very sensitive to how big the cap is, right? Because you don't want to take too much of the company. You want to it's a little bit of a Goldilocks principle. You want to make sure you're getting into the right framework, so that you have enough there and you have enough rights there that if they do raise all that capital, you're going to be in a good position when the liquidity event happens.
Yeah, Chris's company bias aside, right? I mean, it behooves the investor to align those incentives, right? I mean, oftentimes you're investing in the person who's running the company, right? So you want to maintain their motivation, their involvement, and frankly, their chips on the table, right? So it is kind of finding that balance. Chris, are there other key terms in a convertible note? I mean, what if you mentioned maturity date, interest rate? I mean, what are those typically negotiated? How does that kind of work?
Yeah, the key terms are that, the interest rate, the discount, and the cap, right? I mean, that's where your economics are ultimately gonna flow from. Other rights that may kind of come into play. Information rights is one of those. So is the company contractually obligated to tell me what's going on, right? I mean, particularly when you're in a safe or convertible note, you don't have some, sort of natural rights. You keep asking the founder what's going on. information rights give you sort of this like, hey, you're supposed to tell me every month, or you're supposed to, give me an update every year. There's a variation on what kind of rights you ultimately get. But that's always one that no matter how small your check is, I think is one you want to really consider trying to get, right? So you at least get, a basic update on what the business is doing. The next one would be what we call pro rata rights. And pro rata rights are really all about keeping your percentage of the company at, like, so if we're going to go to Series G, all the way down the line, if you have pro rata rights, you're able to maintain your percentage ownership in the company by participating in that next equity round to maintain your ownership interest in the business. Angels sometimes get these rights. Founders tend to resist them because they can create some complexities in the next financings, right? One of the key principles that founders think about is if it came before, it's going to come again, right? So if we give everybody pro rata rights in this round, everybody's going to get pro rata rights in the next round. If we give the lead investor pro rata rights in this round, then the next round, that lead investor will keep it, and then the lead investor in the next round will keep it, and so on. And so again, beginning with the end in mind, a lot of investors will try to limit those rights. That doesn't necessarily mean you won't get an opportunity to invest again. A lot of founders are very, in my experience, they really want to make value for their angel investors or early supporters. And so when it is appropriate, they definitely want to give them this opportunity to continue to invest in the business. But to give people the rights, and then you've got to go through a whole monkey business legal process. It's something that founders tend to avoid. Another more controversial term that comes up is what we call a most favored nations provision. And what that says is if we invested at a $5 million cap and the business doesn't do well and they're doing another round of safes, and that may seem weird to you, but I had a client raise $40 million in safes and 14 different values. So it happens. If something like that, if the next round happens like that, and it's a $3 million cap, what an MFN says is that you're going to get that $3 million cap. Everybody sort of comes along that has that most favored nation provision, or you're going to be able to consider it. You're going to be able to amend your instrument in order to consider that. Go ahead.
Is that, Chris? Is that something that is a typical ask? Like if a company's raising, $2 million on a safe with a $5 million cap, right? And that $2 million, the company's telling us that's going to give us 18 months of runway, right? I mean, is that the appropriate time to ask for most favored nations?
Everything is about your leverage proposition, right? I mean, if in your example, in a $2 million raise, if say an angel or a micro fund is going to put in $500,000 or $750,000 or $1 million, and they're going to be the lead investor, it would not be unusual to draft what we call a side letter where the company says, okay, you're special, you put more money in, so you're going to get this most favored nations provision, you're going to get some of these other things we're going to talk about in a minute. MFNs are pretty not controversial, but they're a big get, right? Because you're sort of circumnavigating the natural flow of the equity, right? So in a normal cycle, when you make an investment as an angel, if it doesn't go well, that's life, right? I mean, the next round is a down round or it's less favorable terms, and that's the way it goes, right? And so you're sort of upending that natural order of things. particularly if you're doing it, as an individual investor. Sometimes we see it as the whole round gets it, but more often than not, it's sort of the special kids get it, and everybody else is kind of out on their own. And that can, quite frankly, that can make other angels grumpy, and it can create some bad cap table dynamics and so on.
Yeah, just one thing that reminded me here. Chris mentioned a side letter. So these rights that we're talking about right now, info rights, pro rata rights, they often don't live in the safe itself or in the convertible note, right? They will be a contractual, a separate contractual agreement, typically called a side letter, right? After the angel has asked for them, right? And the company has agreed.
Yeah. The other right that sometimes comes into play is observer or board rights. And so the question, use Luke's example. We have a $2 million safe raise. It's the first money that the company's raised. The current board is the two founders. The question can come up, well, should the investors have a seat at the board, on the board? And that answer, I think, ties back to that life cycle question, right? Like, where are we going? How much money are we going to raise? In a raise where, a very capital efficient business, we're not going to raise a lot of money over the long term of the business. And again, we're predicting that things change, but we're trying to predict what's going to happen in the future. It might make sense, right? The investors could be key advisors, and it would be, it can help the founder, communicate to the investors. It can help the founder. It can be, basically a focal point for the investors, right? The investors can call this board member and not the founders, right? I mean, that's always kind of a useful instrument for founders, right? Because they're trying to run the business. They're trying to move the needle on the company. On the other hand, contrary to what you might have, I am a huge proponent of keeping the board as small as possible for as long as possible, right? And keeping it in founders' hands as a majority for as long as possible, right? So in a business that's going to use a lot of capital, it's going to raise a number of rounds. You can just kind of do the math, right? Again, what came before is going to come again. So if the angels get a board seat, then seed gets a seat, then A gets a seat, and I've got clients that've got like 5 venture firms on their board, and you can talk to them about like how fun that is. And so you really want to try to think about that now as you make the investment. Even if you have the leverage to get it. The other consideration here, and you see venture firms look at this a little bit, they look at it differently. If you're an observer, what that essentially means is you get to come to all the meetings, you get all the materials, you're in the room, but you don't have a vote. And sometimes investors come to us and they look at that and they go, well, that's not fun. I don't want to have a vote. I want to have a say. I mean, otherwise I'm irrelevant. That is actually not the case, right? If you're in the room, people will listen to you, right? I mean, they kind of have to, right? You're in the room. You can say something, number one. Number two, and this can be an important consideration depending on how the business goes. If you're an observer, you don't have fiduciary obligations to the stockholders of the business as a whole, and to the board itself, and to the executive officers of the business. If you're on the board, you're not looking out for your interests. You're not looking out for the interests of your class. You're looking out for the company broadly defined. And if you are an angel investor and you're trying to build a portfolio, you can only imagine how that can kind of go in bad directions, right? And frankly, there's very sophisticated later stage venture funds that for that very reason do not want to be on the board. They want to take observer seats, and they don't want to have that direct influence.
Yeah, and from the flip side, and you've mentioned this, what's come before will come again. If the consideration on taking an observer seat is, I think, a real consideration, right? Because you have people without fiduciary duties, right? We're trying to, from the company side, we're trying to keep the boardroom as small as possible. Well, if the angel requires an observer seat, the next round there's going to be observer seat, and then all of a sudden we got a very crowded boardroom with half the people in there not being subject to these fiduciary duties, right? So it makes for an interesting, I'm sure Chris can tell you some stories of some boardrooms, right? Makes for an interesting boardroom conversation.
I mean, the classic example is I had a company going into bankruptcy, right? And like you go into bankruptcy, and then you're spending, you have weekly board meetings, right? Or you have daily board meetings because everything's in crisis and you're dealing with a lot of things you don't want to deal with, right? As a board member, and resigning isn't always necessarily the easiest answer under those circumstances, right? Because resigning in and of itself can be a breach of the fiduciary duties of the company, right? So again, it can get really complicated really fast if you hold those rights. Luke, let's come back to valuation. I mean, okay. When investors are looking at the company, how do they come up with this cap? How do they think about the value from an objective perspective?
Yeah, from the outside, I mean, it's I mentioned earlier, right? It's more of an art than a science, right? And there's quite a few, subjective factors that go into the objective value of a company, right? Probably my favorite one to raise or try and explain is geography, right? The fact of the matter is, a company started in Silicon Valley is going to have a subjective value that's higher than a company started in the Midwest, just from pure geography, right? And it may not be right, it may not be wrong, but that's one of the things that kind of ties to this art of valuation. The other is founding team, right? Is this their first time running something like this, right? Or have they gone through 3 exits? How many people have they led before? Is it just one person, or is it 3 people, right? Some of these things are just kind of the baseline for setting this quote unquote valuation of a company in an early stage environment, right? When we're trying to peg this safe valuation cap or convertible note cap. The other thing, and we hit on this a couple times, is, and I truly think, I do more investor side work than company side work. And I have this conversation a lot with my clients is, going back to, I've said it a couple times here, how are we keeping the founders and the people that really matter involved, right? Is taking an extra, 2-3 points for your investment more important than the founder taking 5 to 10 points of dilution, right? And kind of bridging that gap and figuring that out. I have one client who often invests solely, or often pegs their valuation solely on how much valuation the founder is going to take, which is an interesting way to do it, right? But in the early stage, again, these are some of the metrics that you're trying to figure out.
Yeah, the founder one is a really interesting one. Kind of where their success has been. I mean, there's a client that I was on the investor side, and the founder was somebody that had 3 prior businesses that were, 2 of which were public deals, and they went out and they raised their seed round, and they hadn't done anything, and they raised like $18 million like in a week, right? And they were oversubscribed and so on. I mean, so that's like an extreme example, but I think that reputational concept is a huge piece of where the value ultimately lies. I mean, the hard truth is, particularly in the early rounds, it's more, as Luke alluded, it's way more subjective than it is some sort of standard, right? And that's where we sort of get this framework in the Midwest of, okay, well, the basic framework on a cap is 3 to maybe 7, 8 million at the high end. And if you're on the coast, it can be, 10 to 14. And again, like these things, right now, it's sort of, we're an investor-friendly university. These things fluctuate, so don't quote me on that. But there's sort of this sort of sea wave, if you will, where people say, okay, well, right now, based on they did a prior deal and it went okay, and and we're going to get to, a $5 million pre. I really appreciate Luke's comment and his client. I know his client that he's talking about being sensitive to what the founders hold. We're just working with an investor on a deal, and they're getting a $3.2 million cap on their safe. And we told the client, like, I feel it's like too low, right? It's a product business. They're going to raise a lot of money. When it's all said and done, the round is going to take too much. I mean, even though the founder offered it, and it's very weird, kind of counterintuitive. Like, well, maybe you should be higher. And it's a weird dynamic in terms of the negotiation. But this isn't zero sum, right? We want to make sure everybody's winning, because if everybody isn't winning, then nobody wins, right? I mean, that's sort of the premise. So, Luke, tell us a little bit about, from a founder perspective, what makes a good angel? What makes a good investor partner?
Yeah, I think, well, from a lawyer representing a founder, a great angel is one you don't really hear from. And I think that to some extent can be taken from the founder perspective as well, right? I think, we've talked a little bit about kind of all these rights and kind of everything that we can request and, get involved in the business. And I think from a founder's perspective, and again, speaking from the lawyer's perspective, representing founders, is someone who's there to support, who's backed that up through investment in the company, and who generally is not trying to, basically request all the rights that we talked through today, right? And I think let the company and the person that you invested in grow naturally and be there to support, right? I mean, Chris, I'm sure you have quite an opinion on what makes a quote unquote good angel, but and some of this, a lot of this stuff that we've talked about today, Chris has mentioned it a couple times, is check size does matter, right? So if you're a $10,000 check in a $2 million round, it's probably not the best idea to be the squeaky wheel, right? But I think generally from a founder's perspective, the support, both capital-wise and kind of, letting them do their thing is what makes a good angel. From the founder's perspective.
Keep in mind, always keep that check size concept in mind. And even if you're writing a $25,000 check and it's a super important check to you, in the grand scheme of the company, is it important? How important is it, right? And generally, it's not going to be all that important in the grand scheme of the financing of the business, right? And so you're not going to get those broader rights, right? If you're writing a $500,000 check and it's a key, it's a key investment in your fund, or it's a key piece of your net worth, and you need to negotiate rights, and this is a partnership. It's obviously a very, very, very different scenario.
And that check size concept plays at the later rounds too, right?
Absolutely.
With institutional investors,
Absolutely,
right? So it's essentially just a flow down of the concept of a lead investor, right? So
we're running out of time, so like two just broader comments. There's a breakout on QSBS, qualified small business stock, in a bit. one thing when you're thinking about that from a structure perspective is you have to be a C Corp, right, in order to get that. And so that's a $10 million capital gain exclusion. There's way, way more nuance than I know and understand, but it's important to think about that and to make sure that's sort of part of the dynamic as you think about making the investment. The other one is angel tax credit at the state level. Minnesota has a program where if the company meets certain criteria and the investor meets certain criteria, you can get essentially a state income tax credit for your, I mean, it's not a deduction, they'll write you a check for, I think, what is it, 30% of, it's like 25 or 30% of the investment. That sounds wonderful, right? There's some hooks and ladders there. And one of them is that, for example, on these notes is you have to have an automatic conversion feature. So if it doesn't go well, you have to negotiate with the company, how do we get out of this thing right now today in order for you to get that credit? And that's really, really challenging. So there's some real impediments to that, but it is something to keep your mind on. And some founders and companies will really they really want you to get it.
Sounds good.
Yeah.
That's
all we got.